This chapter brought together the full picture of how mortgage money flows through the U.S. real estate system. You learned where mortgage money comes from, who originates loans, who buys loans, and how federal monetary policy shapes the cost and availability of credit. Understanding this flow is essential for every real estate professional because it directly affects buyer demand, interest rates, loan approvals, and the overall housing market. The money supply and the Federal Reserve. You learned that mortgage lending is governed by basic supply and demand for money. When money is plentiful, interest rates fall. When money is scarce, interest rates rise. This cycle is shaped by the Federal Reserve, which controls the money supply through open market operations, buying and selling Treasury securities, reserve requirements for member banks, the discount rate, the rate banks pay to borrow from the Fed. When the Fed wants to stimulate the economy, it lowers rates and increases liquidity. When it wants to slow inflation, it tightens credit and raises rates. These actions have an immediate impact on mortgage affordability. Primary mortgage market. The chapter explained that the primary market is where loans begin. Borrowers apply directly with banks, savings and loans, credit unions, mortgage bankers, mortgage brokers, life insurance companies. These institutions originate loans, assume the initial lending risk, and may service the loan for its full term. You also learned that portfolio lenders keep loans on their own books, allowing them to set their own underwriting standards. Life insurance as a financing tool. A unique part of this chapter was the deep dive into life insurance as a financial resource for real estate investors. Whole life policies can build cash value and become a source of borrowable funds, giving investors quiet access to capital that can help fund purchases, renovations, or other investments. Secondary mortgage market. You explored how the secondary mortgage market keeps the housing market moving by buying loans from primary lenders. This brings fresh capital back into the primary market and allows new borrowers to obtain loans. Major players include Fannie Mae, FNMA, Freddie Mac, FHLMC, Ginnie Mae, GNMA. Private investors and Wall Street firms. Through securitization, these organizations create mortgage-backed securities, MBS, that investors buy. This system spreads risk, increases liquidity, and keeps mortgage availability steady nationwide. Role of Fannie Mae, Freddie Mac, and Ginnie Mae. You learn the distinct roles each agency plays. Fannie Mae buys FHA, VA, and conventional loans, guaranteeing MBS and supporting affordable housing. Freddie Mac provides liquidity by purchasing loans from smaller banks and credit unions. Ginnie Mae guarantees securities backed by FHA and VA loans, ensuring timely payments to investors. Following the 2008 financial crisis, these agencies became even more central to housing finance, with the federal government placing Fannie and Freddie under conservatorship, where they remain today.
Secured and unsecured loans. The chapter also compared secured loans, such as mortgages, which use collateral, unsecured loans, such as personal loans, which rely solely on creditworthiness. Students learned that secured loans carry lower rates because the lender can take the pledged collateral, a house, a car, or other assets, if the borrower defaults. Big picture takeaway. By the end of this chapter, students should clearly understand where mortgage money originates, how interest rates are influenced, how loans move from origination to securitization,
Why federal agencies exist, how federal policy affects everyday borrowers, how investors use tools like life insurance to finance real estate, why loan type, lender type, and market conditions determine loan availability. This foundational knowledge prepares the student for more advanced topics in financing, loan products, and the broader national real estate economy. Discussion questions. Use these for student interaction, classroom conversation, or online discussion boards. 1. Why is the secondary mortgage market essential for the stability of the U.S. housing system? Discuss how liquidity, investor demand, and loan availability depend on this system. Instructor Guide. Students should identify how selling loans replenishes capital for primary lenders, which allows them to continue originating new loans. Without the secondary market, mortgages would be more expensive, less available, and far more localized. 2. How does the Federal Reserve influence real estate affordability? Discuss how interest rate changes impact both buyers and sellers. Instructor Guide. Students should mention that lower rates make homes more affordable, stimulate demand, and increase prices, while higher rates reduce affordability and cool market activity. 3. What is the difference between a portfolio lender and a lender who sells loans to the secondary market? Discuss underwriting flexibility, borrower experience, and long-term risk. Instructor Guide. Portfolio lenders can create unique loan programs and hold loans in-house, while secondary market lenders must conform to strict standards set by FNMA/FHLMC. 4. Why might real estate investors benefit from whole life insurance as part of their investment strategy? Discuss access to capital, liquidity, financial protection, and long-term planning. Instructor Guide. Students should describe the dual benefit of life insurance as protection and as a cash value borrowing tool that can quietly fund deals, bridge shortfalls, or secure investment opportunities.